Now, when the documents are received, it is the accountant's responsibility that he makes sure that the accounts are properly made and the transactions are correctly entered in the documents. The transactions are correctly recorded in the documents. So, what is the flow of transaction? What happens and how the things are done? Let's understand. So, the first step here is the data sources. Basically, this is where the transaction happens, and data sources is basically the documents which are available as a result of any transaction which is happening. So all this data is then entered into the books of prime entry. So there's a little difference in format which we'll see here. This is not similar to what we follow here in India. The basics, the concepts are same. It's just that there's some format difference which we'll see here. The other things are completely same. Okay. So the transaction is entered into the books of prime entry. Then ledger accounts are prepared. After ledger accounts, a trial balance is prepared, and after trial balance, the financial statements is prepared. So this is the general flow of accounting. This is how generally the flow of transaction happens. So once the transaction happens, we record it in the primary books. Then we make the ledger account. From the ledger account, we post all the closing balances to the trial balance, and from that we make our financial statements. So that is how financial statements are made. That's how the flow happens. So let's first understand the first step, that is entering the transaction in the books of prime entry or primary entry. So let's understand what are the different books of prime entry. So there are different books for recording different types of transactions. There are different books which are maintained by business organization. The first one is a sales day book. Now, sales day book is for the purpose of recording credit sales. It is only credit sales. So whenever goods are sold on credit, the entry will happen here in the sales day book. And similarly, whenever there are any credit purchases which are made by the organization, it will be posted in the purchases day book. Now, in case there's any cash sale or cash purchase which is happening, it will be posted in the cash book. Then there's sales return books, purchase return books. So in case there's any return of goods which was sold on credit, it will be entered here in the sales return book. And in case there's any purchase return which is made, then it will be entered here in the purchase return day book. All the cash and bank transactions will be entered here in the cash book, and there are some small amount of transaction, a petty amount of cash transactions which happen. Those transactions will be entered in the petty cash book, and all the other transactions which are not recorded anywhere else, that is in all the other day books, will come here in the journal. So what we generally see is all the business transactions are to be recorded. For every business transaction, there's a journal entry which happens. So what happens here, after all the sales are recorded, there's a journal entry which is passed. So as you all have already told me, customers account debit and sales account credit. We'll understand why debiting customers and why crediting sales. So these are the different prime entry books which are maintained by organizations: sales day book, purchase day book, sales return day book, purchase return day book. There's a cash book, there's a petty cash book, and then there's a journal. So all the transactions, all the different transactions which are taking place in any organization, they are entered into all these different primary entry books, and the sum total of the day's transaction is recorded in the accounting ledgers of the entity. This is done in double entry format. What is double entry format and how things happen here? Let's understand. So here they first talked about sales and purchases day book, but we'll first talk about journal. We'll understand what is journal and how journal entries are first. I'm sure you all must be aware of the general principle or the golden rules of accounting. Golden rules of accounting. Heard of this? Ever heard of the golden rules of accounting? What are the principles, golden principle? Three different types of accounts, and there are different rules which you follow whenever you're passing journal entries for those accounts. Yes. So can someone tell me what are those different rules which you follow? Nominal, personal, and real account rules which are followed we whenever any transaction is recorded. We follow rules of these different types of accounts, or these different types of accounts which are made. Now, simple basics which you all know, uh, but still, let's just brush upon a few concepts so that it becomes easier for us to uh, go to sales daybook and purchase daybook later. So when we talk about a journal is a book where all the business transactions are recorded. All business transactions have a journal entry. A journal entry is passed for all the business transactions which are made, whether it is a sale, purchase, any expenditure, purchase of asset, or incurring any liability, whatsoever it is. For every business transaction, there's a journal entry which is passed. Now, talking about journal entries, certain things which you should keep in mind whenever you're passing a journal entries. First, let's talk about cash. So when we talk about cash, if you are receiving cash, whenever there's any receipt of cash, whenever there's receipt of any amount, we will debit it. And whenever cash is going out, whenever any payment is being made, we credit it. Yes. So one simple rule which we follow when we are dealing with cash, or bank, is if we are receiving cash, we will debit cash account. If we are making payment, then we will credit it. And apart from it, the most important rule is with respect to expenses and incomes. All the expenses will be debited, all the incomes and gains will be credited. So we follow this rule, all the expenses will be debited, and all the incomes and gains which are made will be credited. And you all know what are personal account rules. So what are the personal account rule which you follow? Debit whom and credit whom? Personal account rule. Debit the receiver, credit the giver. This is the personal account rule which we follow, right? So someone who's giving, we'll credit him. Someone who's receiving, we'll debit him. Now, if you remember these basics, if you know all of these basics, basically these three things: how are you treating cash, how are expenses recorded, and how are incomes recorded. Passing journal entries will become a cakewalk. It will be really easy for you to pass any journal entry if you remember the basic rules, if you remember the basic principles, how different transactions are treated. So let's now take a few examples, take up a few examples of journal entries. Now say sales of rupees 10,000 in cash. What will be the journal entry for this particular transaction? There's a cash sale of rupees 10,000 which is being made by by a business organization. So what will be the journal entry? Journal entry, we know when we are making a sale, we are receiving cash. So we have understood that if we are receiving cash, we'll have to debit cash. And sales is an income, so it will be credited. So there's a difference in format here. In India, we write cash debit to sales, but the format which you'll follow here for ACCA is a bit different. It is like this. So debit cash account, credit sales account. So this is what happened. This is the journal entry which we pass in case of a cash sale, which happens. Let's take another example. Sale of rupees 5,000 to Ramesh. What will be the journal entry here? what will be debit here and what will be credit. So credit will again be sales account and debit will be Mr. Ramesh. So every aspect, every entry has got dual aspect, one debit and one credit, and the this total of debit should always be equal to total of credit. There has to be a balance of both. You cannot say I'm debiting cash with 9,000 and I'm crediting sales with 10,000. There has to be one more debit entry in order to balance. So total of debit will always be equal to total of credit. Let's take another example. Salary paid rupees 20,000. What will be the journal entry for this? Salary paid to Srinivas. What will be the journal entry for this? So when we are paying salary, salary is an expense for the organization. So we'll have to debit salary account and crediting cash because cash is going out. Let's take one last example. Purchase of rupees 50,000 on credit. What will be the journal entry for this? Purchase is an expense, so we'll debit purchase. We'll debit purchases account. And credit would be the supplier or the supplier. Supplier's account will be credited. So are you all clear with this basic? Is this basic clear to everyone? Yes. Now let me take one more example, one different example, and then we'll move ahead. Car purchased worth rupees 5 lakhs. What will be the journal entry for this? So car, it is an asset. So we'll debit car. It is a fixed asset which is coming into existence, and we'll credit cash as it is going out. As it is going out. Right. Now, similarly, there could be a situation wherein a non-current asset or a fixed asset is purchased on credit. So then, instead of crediting cash, we'll write the name of the supplier or the mode on or the person from whom we have purchased the car or any other fixed asset on credit. So this is how the basic principle works. Assets will always be debited and liability always credit. Liability are always liabilities will always show credit balance and assets will always show debit balance. So these are some basic rules which you should know. Now one thing which you should be doing right now is do not always recollect debit the receiver, credit the giver, debit what comes in, credit what goes out. Understand the basic principles, understand the logic behind a particular transaction, how it is being recorded. If you look at the things the journal entries which we passed just now, we were only working on logics. We did not use the rules. We did use the rules when we did use the rules, but we were not repeating the rules. Okay, debit what comes in, credit what goes out. Do not That should not be the first thing which comes to your mind whenever a transaction comes before you. Whenever a transaction comes before you, analyze the transaction logically and think what should be the journal entry which should be passed for this particular transaction. Debit what comes in, credit what goes out, or debit the receiver, credit the giver. This was for when you were starting to learn. But once you already know the concepts, passing journal entries has to be a cakewalk. It has to be very simple. And that will happen only when you understand the logic behind how things are done. So here you all were very quick in giving me the journal entries. And I believe that all of you all are very well versed with passing of journal entries with the way you have all answered me. So similarly, whenever any transaction comes before you and you are asked what is the journal entry for this particular transaction, you should be able to quickly give the journal entry and not just think about, okay, what is the rule? Okay, whether this is a personal account or real account, you don't have so much of time to analyze, okay, whether it is personal, real, nominal. You will not have so much of time to analyze. Just understand the things logically and give your answers. So let's have a look at the text about journal, what your study text talks about it. So journal is a book of prime entry which records transactions which are not routine and are not recorded in any other book of primary entry. So we've understood sales day book, purchase day book, all the sales and purchases, they go there. However, if there's a transaction which is not recorded anywhere else, it will be recorded here in the journal. So what are the transactions? Some of the transactions which are recorded in journal, they are the year-end adjustments. So there are certain adjustments which are made at the end of the year, and those adjustments are recorded here in the journal. First adjustment is depreciation for the year. The depreciation is definitely an year-end adjustment. We calculate depreciation on the basis of different methods of depreciation which are adopted or utilized by the organization. And the entry for depreciation is depreciation debit. We debit depreciation and we credit accumulated depreciation account. And basically, this accumulated depreciation is reduced from the cost of fixed asset. So whenever we are utilizing any fixed asset, there is a wear and tear of the asset, as a result of which there's a charge which we reduce from the asset, and that charge is nothing but depreciation. So depreciation is the charge, and depreciation is something which will come here in the journal. Will record depreciation in journal. There's nothing going out, nothing coming in when we are talking about depreciation. It is just a reduction in the value of asset due to its continuous usage. And the entry for depreciation would be debit depreciation account and credit the accumulated depreciation account. And this accumulated depreciation will be reduced from the cost of fixed asset. Then there's some irrecoverable debt which we have to write off at the end of the year. So irrecoverable debt is basically, say for example, there's a debtor and that debtor has become insolvent. You know that this person now has become insolvent and you are not going to receive the amount due from him. You're not going to receive even a single penny. So it's better to write off that debt as bad debt. So we usually write these irrecoverable debts as bad debts. So the entry for this is again passed at the end of the year, because that's when we come to know, that's when we analyze how many assets are realizable and how many assets are not realizable. So here we'll again pass an entry wherein we'll debit this irrecoverable debt and we'll credit the debtor who has become insolvent. Then record the movement in allowances for receivables. So there's a separate chapter on allowances altogether. There's a separate chapter on accrual and prepayments as well. So we'll cover all of these things there. What are the different entries we pass there. And then there's closing inventory. Closing inventory is nothing but your closing stock. So closing stock is again an year-end adjustment which is made. Apart from it, what other transactions are recorded in general? Acquisitions and disposals of non-current assets. So if you remember, the last example which we saw was purchase of car. So that was an acquisition of a non-current asset. Car is a long-term asset, and you all know what non-current assets are. We've done this in chapter 1. So if we are purchasing any non-current asset, what will be debited? If we are purchasing any non-current asset, what will be debited? If we are purchasing any non-current asset, non-current asset account, the asset account will be debited, and asset is being formed, is coming into existence. So the assets account will be debited, and credit will be depending on whether it is purchased on cash or purchased by payment of cash or credit. We will decide upon the credit aspect. So acquisitions or sale, if we have an asset and we are selling that asset, all those transactions will be recorded in the journal. Apart from it, opening balances for statement of financial position items are part of journal. Then correction of errors. If there are any errors which have been made when passing any journal entries, then correction of errors or rectification of errors is also something which is done in the journal. So the format is like this. So debit, account, amount, credit, which account are you crediting, and the amount. So this is how, this is basically the format. This is basically the format which is followed. Is this clear? Are you all clear with journal? Any doubts in journal? There's no specific entry for closing inventory. To be very honest, there's no specific entry for closing inventory. But if you ask me, that'd be one journal entry which would be closing inventory debit and closing inventory credit. The reason being, closing stock. What is the treatment you give to closing stock when you are doing final accounts? If you remember, can you tell me what is the treatment you give to the closing stock when you're doing final accounts? Say you're preparing final accounts. What would be the treatment of closing stock? Show it on asset side. Is that the only treatment you give? There's one more thing you have to show. So closing stock is nothing but your inventory amount of inventory, which appears on the asset side of your balance sheet. What is the second effect of closing stock?
It will be shown in trading account, ma'am.
You show it in trading account. So that's the reason why there's no specific entry for closing in my specific entry for closing inventory. It is closing stock debit and closing stock credit, or closing inventory debit and closing inventory credit. So when we credit it, it goes there to there's one effect wherein we show it on the asset side, and the other effect is wherein we show it in the profit and loss account, or sorry, trading or profit and loss, trading and profit and loss account on the credit side. So there is no specific entry, but this is how the treatment is given. So the entry which comes up is the same account debit and the same account credit. Apart from it, there's no other specific entry for closing inventory. I hope it is clear. So let's now move to a day book. Let's have a look at sales day book and purchases day book. And there are also few questions which we have to do. So let's first look at the format of sales day book. What are the transactions which we enter in the sales day book? Which transactions do we enter in the sales day book? Credit sales. So all the credit sales will be entered in the sales day book. Cash sales will go to the cash book. Let's have a look at the format. So sales book, it summarizes the daily sales which are made on credit basis. Cash sales are recorded in the cash book. What is the format for it? So first write the date, invoice number if any, name of the customer, ledger reference number. So this is nothing but your ledger folio, and then the amount. So let's ignore these two columns for now. Writing the dates on which the sale is made, the name of different customers, and the amount of sale which has been made to respective customer, and then we finally arrive at this total figure. Now this total figure, for this total figure, we'll have to pass a journal entry. What would that be? Customers debit, credit, sales to the tune of 20,200. This would be the collective journal entry which we would pass on the basis of the amount which we arrived from the sales table. So the format is date, customer, amount. And similarly, purchases day book, same format. All the credit purchases are entered in here in the purchases day book. And we enter the date, the name of the supplier, the amount due to them, and finally the total amount of purchases which have been made. The entry here would be purchases account debit to the and all the different suppliers credit. So let's have a look at an illustration based on purchases daybook and sales daybook. So here you are going to give me answers. I'm only going to ask you the question. Okay. So MK Ling runs a business providing equipment for bakeries and always make notes of sales and purchases on credit and associated returns. So this person, MK Ling, he is into the business of providing bakery equipments, and he always makes a note of any sales and purchases which he is making on credit, and also the returns which are being made. However, MK Ling is not sure how the transaction should be recorded for the purpose of his account. So he does not know how the transactions are to be recorded in his accounts. So now we'll look at every transaction. We'll also post these transactions in different day books. But first, let's analyze that where the different transactions have to go. So on 1st of August, M. Bakewell purchases cake tins at a cost of $500. So there's a person, M. Bakewell, who has purchased cake tins at the cost of $500. Purchase here means what? From MK Link's point of view, it is a sale which is made. So this transaction will go where? Where will this first transaction go? Which day book will the first transaction be recorded in? Has to be recorded in the sales book. It cannot be. It is not a cash purchase. It is not a cash sale which is being made. It is a. These are all credit transactions. The question clearly mentions that this person MK Ling, he records all the transactions, all the credit transactions, and this is a credit transaction which is being made here. So this first transaction, we'll have to post this in the sales daybook. Okay. The second transaction is MK Ling purchases equipment at the cost of $2,000 from wholesalers Tin Pot Limited. Where will this transaction be entered? Which book will you enter this transaction? The purchase is being made by MK Ling. Yes, this transaction will go in the purchase day book. There's another transaction, MK Ling return good costing $150 to another supplier, iCook. Where will this go? Purchase returns. There's a purchase which was made wherein now the person is returning it. So this will go to purchase return. Jack Flap buys equipment which costs $1,200. This is again what? What is happening here? A person Jack Flap is buying an equipment. So when Jack Flap is buying an equipment, MK Ling is selling the equipment. From MK Ling's point of view, it is a sales. Then M Bakewell returns $100 of goods which was supplied to her. Where will this go? Sales return book. B Sands buys a new oven for $4,000. This is again a sale which is made. This will go to sale. Then MK Ling purchases baking trays for $500 from a regular supplier, Tintin Limited. Where will this transaction go? Purchases. So this is a purchase which is made. So this transaction will go to the purchase table. So let me just post all these transactions first so that there's no confusion later on. Or okay, let's first finish all of this and okay. So here I have the formats ready for sales daybook, sales return daybook, purchases daybook, and purchases return daybook. So the first transaction, which was M. Bakewell, she purchases cake tins at the cost of $500. So as you all said, it is a sale which is being made. So date is 1st August. Name of the customer, amount is 500. Then there was a purchase which was made by MK Ling from Tin Pot Limited for $2,000. Then there was a purchase return which was made to a supplier iCook. Amount here was $150. There was a sale made to Jack Flap. And there was a sale return which was made by M. Bakewell of $100. There was another sale made to V San, $4,000. There was another purchase made from Tin Limited. Right. Let's look at the other transactions now. So the other transaction here is, are you able to, what are you able to see right now? Is it the study text or is it my Excel document? So the other transaction is MK Ling purchases oven costing 10,000. So this is again a purchase which is being made. So this has to be entered in the purchases daybook. What about this transaction? MK Ling returns equipment costing $300 to Tin Pot Limited. Where will this transaction go? Purchase return. Pavlova purchases good costing 2,200. Where will this go? What about the last two transactions? This is a sale which is being made. This is also a sale which has been made. So let's now post all the transactions. So there's another purchase made from Hot Stuff Limited, amount being $10,000. There's a purchase return to Tim Port Limited, being $300. So with this, we've now posted all the transactions in the respective books, in the respective day book, sales day book, purchase day book, sales return day book, and purchase return day book. Now what we have to do is we have to calculate the total of all the transactions which are being made. So the total sales which are made by this particular person and killing is 8,500. There's only one sale return, so the total of sales return day book is 100. Talking about purchases, purchase to the tune of 12,500 has been made, and total purchases returns are 450. Now, what type of questions are asked in exam? How do they ask you questions in the exam? You do not have so much of time to make all the format in the exam and ascertain all the things. All you have to do is analyze where in different amounts will go, which day book are you going to post the different amounts in, and on the basis of that, calculate what would be the total of different books. So here the required part here is write up the following credit transactions arising in the first 2 weeks of August into the relevant day book. So they have asked us to make relevant day books. So this is how the presentation has to be. This is the same presentation we did there here in the Excel. Ultimately, the question would ask you that what is the total of sales day book, or what is the total amount in the purchases day book, or the purchases return day book, or the sales return day book, as the case may be. So this type of questions may be asked. So are you all clear? Any doubt here in the format? Any doubt with respect to sales return book or purchase return book or purchase day book, sales day book? Clear how the posting has to be done? What is the format of all these different books?